And within about 3 billing cycles, almost every single one of our international clients switched from dollars to Bitcoin. Everybody initially wants to pay in dollars. Nobody wants to give up their Bitcoin, especially back then. But they would all switch to Bitcoin simply because the rails of moving money, especially internationally, so painful. So that was maybe a more extreme example where you've got like larger amounts of money, I guess business money that's moving and is international in the early time with Bitcoin companies. But the friction of moving money is there. And we all see it. Our banks run very poorly. You've all had an experience trying to wire money from somewhere to somewhere. Bank charges you $100 and can't even get the wire through. What kind of business is that? You fail and you still charge the client. All right, so stablecoins are absolutely going to become the dominant payment mechanism in digital assets. At BitGo, we built this thing, we call it the Mint Burn Center. At this point, you can mint, you can burn at almost no cost any of the stablecoins, convert them in all kinds of different ways. Our clients have a real issue. They need to be able to get kind of in and out of these things. The entire industry is building liquidity, and liquidity is key. Any asset you're going to hold that you're going to use as a payment rail, you need to know that you can get to and from wherever else you need to be. So it's had a major impact. It's an impact on trading. Of course, we've got the Mint Burn Center. It'll continue on payments. I think the next step is getting micropayments going, agentic payments going. All of these things are happening, and it's going to come really fast.
So in our case, we focus on tokenization of real world assets, but focusing on securities. So we tokenize things like treasuries, bonds, equities, high yield products, credit, etc. And when you deal with securities, every single transaction involves also dealing with dollars as a counterparty, right? Whether you need to trade, a security against a dollar, whether you need to, pay a dividend, whether you need to invest on a fund, etc. So the whole promise of why tokenization of securities or tokenized securities are superior is because on the same ledger technology, you can actually represent with the same underlying technology a dollar and a security. So stablecoin is a tokenized dollar, and tokenized securities are the counterparty. So everything we do, when we actually do it in conjunction with the stablecoins, it becomes better. We can do instant investment on a fund and receive stablecoins and mint securities instantly, so your funds are deployed instantly. We can do instant settlement on chain by swapping stablecoins against, let's say, equities. We can, distribute dividends in a very efficient way by just distributing stablecoins to wallets, knowing in real time what the balances are, etc. So the whole, idea of tokenized securities is predicated on the fact that you have also tokenized dollars alongside. So when I started the business, I think Tether was the only one that existed, and it was like $1 billion. USDC actually launched in September 2018. So the fact that now stable coins have scale and have like around $200 billion is something that benefits also our side of the business, because we can then use tokenized securities in a better way.
So I think the important thing to recognize with stablecoins is really solving two things. One is a better rail, 24/7, instantaneous, programmable, cheap, et cetera. And then you have an account structure. And an account structure means that someone can hold it without needing an intermediary. And that's what you get with the stablecoin that is so powerful. Just upgrading the rails, that's really great, that matters. But where you're really seeing, I think, the innovation happen is where you can add the account structure element into this as well. And there's lots of other firms that come along and they want to issue their own white label or consortiums that want to do it. There's only going to be a couple global rails, so you probably don't want to have hundreds of stable coins that are trying to be global rails, but you could have hundreds of stable coins that are creating some effect for a community, for a chain, for a set of users that allows you to have a different experience. And so that could potentially exist, just like there's many different types of rewards cards and prepaid debit cards, but there's really only a couple networks. It's a rough analogy. But I think the important thing is that you're really changing the way money operates by having an ability to control an account when you didn't before, simply by having a wallet on your phone. And that's an enormous democratizing access for the US dollar and for the whole financial system. And as you get into agentic commerce, this will become even more and more important, because you're going to want to be able to create units and accounts that are fully programmable, because you're going to have actors that are operating as programs. I think that all just makes sense.
And so if you think about what's possible when you start changing the dynamic of inter-party settlement, you start changing the dynamic of allowing smaller financial institutions to leapfrog antiquated technology and move to a newer settlement modality. Even on the back end, you change nothing else. That has the potential to really supercharge an institution that was dying and make them into an institution that can not only survive, but now thrive. And so whenever we post these types of things, we like to post stuff about what do we actually see in practice, right? Rain today, we power, over 100 different programs today. We power billions of dollars of payment volume around the world for end users in dozens of markets around the world. We also have been able to operate our business, right, versus the traditional enablement model at about a 90% more efficient working capital basis than was previously possible. And this is simply because we don't have to be bound by settlement modalities driven by working hours or by working days or by weekends or holidays. We can settle 7 days a week. We can settle with our customers 24 hours a day. We don't end up having to take risk on a counterparty. And if you look at, when you look at the world, when you look at when most banks collapse and when most counterparties collapse, they generally collapse after business hours on Friday. That is not accidental. That's because somebody's forcing you to take that counterparty risk over the weekend. And so in a 24-hour marketplace that has 24-hour money, that's a choice. You no longer can be forced into that position. And that is a meaningful difference between what is qualitatively better versus what is qualitatively the same.
Look, crypto was born for AI. I mean, yeah, of course AI is going to be using a digital money. They're not going to be using a non-digital money. Maybe we have to worry about the robots creating their own money and excluding us from it. Maybe that might be the biggest worry for the long term. But look, the types of protections that you put in play in order to secure wallets, and we pioneered multi-sig a long time ago, but we do, how do you eliminate single points of failure? How do you share those across multiple parties? How do you make sure that your company can have somebody leave and you still have access to the money? When you throw a robot into the mix, the robot is actually like a human. It's like another person on that wallet that has some set of permissions. So actually it fits right in with what we've been doing for a long time. So I think there's a lot of excitement about what's coming with agentic payments. This has actually already been built and is ready to go. There's a little bit, I think, to be done on the identity side, which is moving, I think, a little bit more thanks to AI than it has. We've been talking about identity for a long time. But for the most part, I mean, of course, this is just perfectly ready. I think anybody that is not excited about crypto but is excited about AI, they're kind of forgetting that these two things are going to go hand in hand.
Yeah.
So it's a very exciting time all around.
Yeah, it's earlier today we announced our Agentic Payment Alliance. It is a partnership with Rain and a number of other institutions around the world that are focusing on creating universal standards for agentic payments. We're working with folks like Visa, we're working with Mastercard, we're working with even folks like Fiserv to start building more of an interoperability layer between various initiatives. If you look at any new industry, the beginning is folks trying to toil away alone to build their own standard. And then generally, to make sure adoption happens, you have to connect it to how people already transact. And that's generally over existing payment modalities. And then the next phase is, okay, how do you bridge the gap and kind of close the loop? And all of that needs to have standards that everybody can iterate against. They can always integrate, they can work together. Everybody can build their own version of that. They can build their own ecosystem on top of it. But ultimately, I think setting standards is very important. So that's what Rain has been focusing a lot on, is how do we bring folks together to establish sort of the base layer for what agentic payments can look like.
So if you think about what a lot of the role of a portfolio manager, depending on what are you managing, it is rebalancing portfolios, right? Like you have a number of reserve assets, and you're moving from treasuries into bonds, and from bonds back to treasuries, etc., just to make sure that you are always in the right kind of risk reward threshold that you want to be. The same thing with equities, etc., and that when the underlying assets are programmable and they move 24/7 and can be you can move them through APIs, etc., that's when agentic trading becomes a reality, right? So you need the AI side, as Mike said, they're complementary, right? Because if you have an AI agent that can trade, but you don't have the underlying assets that can actually be moved programmatically, then you only have one side of the story. So I do think that, you know, crypto, and in our case, tokenization of real assets is extremely complementary with, you know, with AI.
So, I mean, I think I talked a little bit about how important agentic commerce will be, and I think it's inevitable that it's going to be a critical feature and use case of crypto and blockchain, because you need to have some way of creating a source of truth. And you need that source of truth to be digital and composable, but it has to exist in a way that users can use. And now you have a new type of user, which is an agent. And there's not going to be a few agents, there's going to be lots of agents, and they are going to probably be the main actors that are moving funds around. And so, well, what are they going to speak? They're going to speak in some type of digitized money, which I think is likely stablecoins. But it could be other things too, and they're going to be trading and, you know, being able to move around all kinds of portfolios. Today, you could just download. You could probably go to OpenClaw and you could just use a MetaMask wallet, and you could give it like $20 and say, hey, go ahead and come up with a return profile that I want. I don't know, 20%, and go make investments. And by the way, it's not going to do a very good job. But the whole point is you can still do that. You can already do that. And so what is it going to be like in 3 years or 4 years or 5 years? I mean, I think the direction of travel is pretty obvious, but you know, it's not going to be exactly linear. Wherever you're at on the S-curve, it's very hard to extrapolate. And you know, I don't think we're quite at a place that I would call maturity by any means.